Let's pull up a Chennai Petro. That stock is in focus as well in today's day of trade, and that's mainly on the way earnings have panned out. The stock is down nearly 1.8%. Let's quickly look at what the numbers are looking like as we speak in terms of Chennai Petro. I'll just quickly take you through. The profit number is coming at 450 odd crores. The revenues have grown around 34%. Margins have come in at 4.6% versus 1.9%. Now, mainly the higher capacity utilization as well as the inventory gain and higher, and you've seen higher gross refining margins as well. In fact, let's welcome in Mr. H. Shankar, Managing Director at Chennai Petro. Mr. Shankar, good afternoon and welcome to the show, and thank you for speaking to us at NDTV Profit. With the kind of growth that we've seen with regards to margins and the profitability, is this an exception, or do you think this is the kind of growth that is expected to continue in the coming quarters?
Good afternoon. Yeah, nice to be here speaking to you about the performance of CPCL. In fact, I would not say it's an exception because if you had looked closely at our Q1 figures, we have done better than the Q1 figures, and we are now, I should say, after a sedate Q2 and Q3, we are actually coming up with the correct figures that CPCL is capable of doing now. And this mostly, I would say, it is on the back of some good cracks that we had, and also after having gone through a shutdown cycle that we had between the Q2 and Q3, we are now operating at a very high level of 115% the capacity utilization, and we have done a lot of tweaking in our operational areas so that the efficiencies with regard to some of the major parameters, for example, the capacity utilization is number one. Number two is about the fuel and loss, where we have achieved the best figure in Q4. We have done extremely well in the distillate yield also. So these are the operating parameters which are very important to sustain this level of operation. So I would not say it is a one-off condition. It is something that we have done close to this in Q1, and we have done better off in this Q4.
Right. So, Mr. Shankar, my second question to you would be, how are the product cracks in the near term panning out? Because that is what has supported this quarter. And secondly, the revenue growth and margin target for FY26.
Right. First, about the cracks about this particular year, I would say over the full year of 12 months, we have seen the cracks around, for a diesel, for example, the cracks have been around $8 to $12, $9 to $12. We have seen the MS also close to $8 to $12, and we have seen ATF also in this range. We have been almost in this range we have been operating, although at certain periods of time we have seen the cracks dipping very below also. For example, the MS has seen $1 per barrel, also HSD has seen $5. These are all kind of up and down we have seen, but on an average, the quarters have been yielding almost at the rate of 8 to 12 or 6 to 8% on the MS, $6 to $8 on the MS. So I would say it's a very stable scenario as of now, but for those occasional ups and downs. So if we continue to operate in the same level of these cracks, I think we should be able to sustain good operating level in the coming period also.
Mr. Shankar, you didn't mention about your FY26 guidance, but if you talk about your Singapore GRMs of late, they've started to improve. From $3 per barrel, it has increased to $5 per barrel in the first quarter of FY26. So are your product margins also improving? And if so, can we expect the first quarter to be better than the fourth quarter?
See, if you look at the Singapore margins, you can say that Q4, we have done a GRM of about 6.6 and 6.6. At the same time, the GRM of Singapore level was about 3.1. That was what in Q4 that Singapore GRM was, and we have done almost double the Singapore benchmark. And also on the annualized basis, you can see that our GRM was 4.22, while the Singapore GRM was around 3.7. So I think if we compare CPCL performance with respect to the Singapore benchmark, I think we are always doing better than that. We need to do much more than that in light of the current operating levels that we are able to achieve.
And Mr. Shankar, Harsh also joining in. So what's the revenue growth and margin target which you're expecting for FY26? What's that number looking like?
See, revenue growth is a direct, I would say it is related to the kind of operating levels that we can achieve. See, in the last financial year, 23-24, I mean the previous year, we had achieved a financial capacity of almost 11.6 MMTPA. Whereas in the last financial year, 24-25, because of the turnaround cycle that we had to maintain for the health of the units, we have achieved 99.6%, which is close to the nameplate capacity. But if you see, in spite of having a turnaround of critical units, we were able to achieve close to 100% of our capacity utilization. So looking forward, I think we have one more shutdown, which is coming up in the month of August, September. Nevertheless, we have set ourselves a target of more than our nameplate capacity, so that the more the capacity utilization, our revenue figures should also see a jump in the overall final figures.
And sir, what's the capex guidance like for FY26? And also, if you can give us some perspective with regard to Cauvery Basin Refinery, the capex plan was hiked, or there was an escalation there. What's the update there as well? If you can give us both of those.
Okay. Initially, first I'll talk about the Manali refinery, which is operating at 10.5 on a nameplate basis.
Sure.
Here we have a capex of, normally we do around 400 to 600 range of crores per year. That is the normal range where we operate. This is mostly with respect to our revenue requirements that we have this capex coming in. But at the same time, we have a couple of projects lined up. We are having a lube oil expansion project, lube oil LOBS, which is called the lube oil base stock project, which is coming up, which is close to the final approval stage. So with that coming in, our capex figures should also be able to see much higher figures than the 400 to 600 that we normally operate in the range of. So that is one side. Looking at the other value additions that we have in mind, for example, last financial year, we introduced a new product called the Pharma Grade Hexane. So we are constantly innovating, and then we are coming up with new products which are suitable for the market that we are looking at. And those kind of small innovations add a lot of margin to the bottom line, and we are able to maximize those returns. And on the Cauvery Basin, as you very well know, that the project was conceived as a joint venture between CPCL and IOCL. And right now the project has been put up for the approval, necessary statutory approvals. Once that comes in, that will also be a substantial capex induction will be required. And over a period of 39 months, we would like to go ahead with the project after the statutory approvals are in place.
Right. So those are going to be interesting moves, that one should be watching out for. Thank you, Mr. Shankar, so much for speaking to us.